Okay, the crash is here, guys. Time to break out the emergency plan.
Oh my god.
Sell everything.
Sell it all.
But first, very quickly, make myself a coffee and go sit outside. Oh, and don't forget, last step, let me just quickly redo this. Make sure that's done. Ah, good. That feels a lot better. Whew. Okay, I've not actually sold anything, but clearly a lot of other people have been, as things are not looking pretty out there on the stock market. We've got all of our major indexes in the red, having some of the worst starts to the year they've ever had. The S&P 500 is down 16% so far this year, the Nasdaq is down 25%, but at least showing some kind of glimmer of hope is the FTSE 100 only down 2%. Well, thank God for that. Things have been even worse for you if you've been picking individual stocks or buying more risky investments. Cathie Wood's famous ARK ETF is now 60% down year to date. It's almost at the same price it was on the lowest day before the pandemic. Wow, now that's pretty bad. If you followed YouTubers for investing advice, you'd also be deep in the red. Companies like Tattooed Chef are also down near all-time lows. Palantir is around $7 a share, and even Coinbase, one of the biggest IPOs of last year, is now 80% down from its highs. Who would have thought this could have happened so quickly and things were going so well? So what have we all missed and what's causing this to happen? Let's take a look at that first before looking at what we might actually be able to do as investors to get ourselves through it. There's a lot going on at the moment, so let's run through each of the catalysts that are causing stocks to have a bit of a mini meltdown. Firstly, there are always concerns around the Federal Reserve in the US increasing interest rates as they try and battle inflation, which is currently running really high, around 8% in the States. Higher interest rates mean the cost of borrowing money for both consumers and businesses gets more expensive, and therefore it's more challenging to grow businesses and purchase assets. Now just think about things like big purchases like homes and cars, for example. The same is happening here in the UK too, as the Bank of England increases their interest rates. Remember, the whole reason they do this is to balance the amount of inflation we have in the economy. Just like Goldilocks and the Three Bears, we need to have things just right, not too hot and not too cold. Next up, as we just touched on, inflation. It's currently running super hot all around the world, caused by a number of issues, whether that's supply chain shortages, high demand, and of course let's not forget that major economies virtually printed loads of extra money and poured that into the economy. More money fighting for the same things causes the price of things to go up. It's just basic supply and demand. Some of the worst hit areas are currently energy costs as the price of oil shoots up, and other areas like second-hand cars and houses. Cars are currently having a rise in value as newer models are still waiting on those microchips to let them hit the forecourt, meaning that older second-hand cars are taking the lead to fill in demand. And then the housing market is also taking the lead because of low levels of supply, a jump in demand since everyone's out of lockdowns, and let's not forget that with low levels of interest, buyers can get some pretty cheap and sizable loans. Also, let's not forget about lots of other events happening in the world at the same time, because they all have their part to play. We can't forget about the ongoing conflict with Russia and Ukraine. This has major implications on supply chains and has reminded the world that we've become a lot more reliant on letting some countries take the lead in producing certain goods. For example, Ukraine's a main exporter of grains and sunflower oil, which means that there could be shortages around the world for these goods. And then heading further east, the second largest economy in the world is currently still going through some severe lockdowns, putting enormous challenges on the supply chain. Container ships are backing up waiting to be loaded and unloaded, and then factories are shutting down whilst the Chinese government tries to keep COVID under control with its really strict lockdown and testing policies. So you could say there's quite a lot going on at the moment. Investors are scared, the volatility index is high, and you can see that there's very little out there on the market to actually move your money to that will give you a positive return to actually beat inflation. Some really challenging times. Now the big question is, should we be worried about things dipping lower, and is there anything else out there that could give us the clues we need? What about looking at previous crashes too, as there has to be some lessons there, surely. During past crashes, here's what's happened, and bear in mind that almost all of us here on YouTube weren't active in the market during these times. None of your favourite creators have actually invested throughout a proper market crash. It's just something reserved for the history books. If we look beyond the crash of 2020 from COVID, the next significant event was the 2008 financial crash. We all know the story here. Too many people were given way too much credit to buy homes. People with very little income had to pay no money down and were given mortgages for 100% or more of the value of the home. Those mortgages were then bundled together and sold to other institutions, and just like in this scene from The Big Short, once people started to default, the whole house of cards came tumbling down and brought everyone else with it.
B's, 0. Double B's, 0. Triple B's, 0. And then that happens.
At its lowest point, the market took a 57% drop, and it took 1,379 trading days to get back to break even. Then before that, over 20 years ago, we had the dot-com crash. A speculation bubble fueled by lots of debt where every man and his dog was buying companies that were set to change the world with the creation of the internet. This crash also lasted a pretty long time but didn't quite fall as much as the financial crisis, although it still dropped the market down 29%. Many companies went completely out of business because they had promised the world and failed to deliver, and even popular stocks that would have become giants of today like Amazon fell more than 90%. I wonder if there's anyone watching who still has those shares from back then. Comment below and let us all know. So is there anything from these crashes that we can learn lessons from? Well, it certainly shows that it can take a very long time for the market to bottom out, and that 50% from all-time highs is perfectly possible. However, what about comparisons to today? 2020 saw a lot of money added into the system. In the US, consumers were given stimulus checks directly, and here in the UK, we had the furlough scheme where employees' wages were paid up to 80% to stay at home. Central banks also bought a ton of government debt in the form of bonds, taking their balance sheets to eye-watering levels. Kind of like how some of the homeowners back in 2008 would have felt sitting in a brand new home but only making minimum wage. As we know, this can't last forever and the money needs to get paid back somehow. However, unlike the crashes that have come before, the economy looks different. And if we take a look at companies' earnings too, things don't seem to be slowing down, at least for the big boys. Take a look at Visa's latest earnings report from the first quarter of 2022. With millions of cards out there, this company can give us a pretty good guide on what consumers are actually doing. They saw a 20% increase in payments volume from the first quarter of 2021 to 2022. That's a significant increase, so no slowing down there. People are still splashing it on the plastic. And here's another bit of data that I think also looks interesting and maybe should give us a little bit of positivity amongst all of the red thumbnails on YouTube. Look at this data from the US that shows consumer debt as a percentage of disposable income. Basically, what's left in your pay packet once you've paid back everything else. If things were bad, we would expect this to be pretty high, as this says that consumers would owe a lot of money. However, the data looks to show a fairly average level, and certainly nothing as bad as the dot-com bubble or even before the financial crash, as you can see here. Finally, unemployment. I'll use data from the US here too, because no matter where you are in the world, it's a good measure and useful to know. Even though it's more of a lagging indicator, something that only gets a lot worse during a crash, we might still expect to see issues with employment if companies start to see things slowing down. And so far, it's going in the other direction as people get into work and companies demand more staff for their businesses. Again, no slowdown here, apparently. So it's not pretty out there in the stock market, but it's not all that bad in the economy, or at least not everything. We've got no idea what's ahead of us, so let's put together a plan. How can we survive the stock market crash of 2022? First things first, stick to the plan. If you're a long-term investor who invests in the stock market using index funds every month as you get paid or some other regular basis, then keep with the plan. If anything, when markets are depressed like they are now, you've got to count yourself lucky, as you're pretty much getting a sale. Over the longer term of 5, 10 or even 20 years, the global markets will likely be a lot higher than they are now, so your average cost price will be really good if you keep it up. I've done this over the years and it's worked pretty well for me. Avoid speculative stocks and stop tinkering. This is probably going to be a very volatile next few months, and if you think you can time the market by jumping in and out, you're most likely going to get burnt badly. Unfortunately, the market is going to punish stocks that don't produce positive cash flows or are more speculative, or happen to be inside any of Cathie Wood's ETFs. Sorry, it's just too easy not to joke about. If you pick stocks and hold conviction in your picks with solid long-term fundamentals, then nothing's changed apart from the conditions outside of your control. But please don't put all of your eggs into Tattooed Chef or Rivian. Just don't do stuff like that. I've made so many mistakes in the past trying to time the market. In fact, I was out of the market during the 2020 crash and I really struggled to get myself back in. It's so hard mentally to push your money back in once you're out of the market. Ultimately, it cost me a lot of money, so that's another lesson learned, and there's been plenty of occasions where I've done the same thing before that too. You live and learn. Also, if you ever want long-term reassurance about the stock market, zoom out. Go to Google, go to Yahoo or whatever you want and get the S&P 500 up in front of you and look at the long-term trends. Markets are likely to head in one direction in the long term, but in the short term, anything can happen as it's never going to be a straight line up, which again is why dollar cost averaging and investing over a long period of time puts you in a really great position. Now, nothing is certain though, so please do your own research and be really careful. I'm not a financial advisor, just sharing my own thoughts and opinions. At any point in history, there's always going to be something to be down about, some crisis somewhere in the world, and the end of civilization is always in sight. It sells newspapers and it gets clicks, but as long-term investors, we've just got to treat that as entertainment and keep on with the plan. Selling out of investments or saying you're never going to invest again would probably be one of the worst things you could do for your long-term prospects, at least in my opinion. Keep your emergency fund handy, make yourself secure in your work or your career by being indispensable, and stick with whatever plan works for you. I've got no idea if things will get worse from here, where the bottom is, and what stocks are going to go up or down now. And remember, importantly, neither does anyone else, especially on YouTube, considering there are so many brand new investors who only just got started during the bull market of 2020 and 2021. So keep your wits about you. If you've got the battle scars from 2008 and 2000, then I'm sure some new investors would love to hear from you below, so make sure to take a moment and let us know your best tips. I'm completely invested in the market with all of you, and I'll keep posting regular portfolio updates from all of my different pots inside my stocks and shares ISA and outside of it, even when things are in the red. If you are interested in any of my latest ones, feel free to check the description for the link to the playlist. Anyway, thanks for watching until the end. Please drop me a big fat like, subscribe for more content like this, and as always, happy investing.